Picture this. It is March 2014. You are standing in a supermarket in Caracas. You have a wallet full of Bolivars. You are technically a millionaire. But the shelves are not just empty. They are structurally barren. The government just released a report claiming inflation is a manageable 60%. But you know the truth. The street rate is hovering above 300%. And here is the kicker. It does not matter how much cash you have, because the Product Scarcity Index has just crossed 25%. That means 1 out of every 4 basic goods, milk, flour, medicine, simply does not exist. It cannot be bought. The currency has not just lost value, it has lost utility. This is the moment where economics ends and physics begins. This is the scarcity gap. And if you think this is a history lesson about a failed petrostate, you are dead wrong. Look at the data from January 2026. Look at the liquidity drying up in global markets. The mechanism that destroyed the Venezuelan middle class is the exact same mechanism flashing red on our econometric models for 2027. They thought they were different. They thought oil wealth made them immune. Today, we are performing a forensic autopsy on what actually trades when the dollar dies. We need to strip away the academic jargon and look at the crime scene. The mainstream media feeds you Consumer Price Index, or CPI. That is a manipulated metric designed to keep you calm. The real metric, the one that determines if you eat or starve, is the scarcity gap. Let's look at the Venezuela case study again. The government there actively manipulated economic history in real time. They retroactively revised June inflation data from 5.7% down to 4.4%. They changed July's 5.5% to 4.1%. They were cooking the books while the kitchen was on fire. Why? Because they wanted to hide the volatility. But the market always finds the truth. While the official inflation rate sat at 60%, the scarcity gap widened. The real inflation was 300%. This creates a bifurcation in the economy. You have the official world, where prices are controlled and shelves are empty, and the real world, where prices are astronomical but goods actually exist. In this environment, cash is not an asset. Cash is a liability. It is a melting ice cube. The only thing that trades is access. We saw this in Lebanon. The central bank there executed an overnight currency devaluation of 90%. 90% of middle-class wealth liquidated in a single press release. If you held Lebanese pounds, you were wiped out. If you held hard assets, or better yet, access to logistics networks, you survived. This brings us to the hard truth of 2027. Our econometric models are currently projecting inflation in distressed economies to trend around 310% in 2027 and 180% in 2028. This isn't a recession. This is a mathematical impossibility of repayment. The public debt sitting at 25.8% to 39.3% of GDP in these failing states is just a number on a screen. The reality is the scarcity index. Most people think trading in a collapse means bartering gold coins for bread. That is a fantasy. History proves that the primary trade is logistics and information. Look at the data from the Data Against Natural Disasters archives. In 2001, Claude de Ville de Goyer retired as Director of Emergency Preparedness. By 2005, following Hurricane Stan, they had to implement a completely new logistics support system, LSS. This system has been used in 9 major disasters since 2005. Why? Because the standard supply chain breaks instantly. In 2009, during the Great Trade Collapse, we saw global credit markets freeze. This wasn't just about stock prices. The specialized financial instruments, letters of credit that grease the gears of international trade, stopped working. Ships literally stopped moving because no one trusted the counterparty to pay. When trust evaporates, trade creates a vacuum. In that vacuum, the person who controls the last mile of delivery becomes the central bank. In Russian-occupied Kherson in 2022 or Sarajevo in 1993, the trade wasn't money. It was the ability to move a product across a checkpoint. If you are building a portfolio for the coming cycle, and you don't have exposure to physical logistics or local production, you are effectively shorting reality. You are betting on a system that has already shown its cracks. This is the most contrarian point I will make today, but the data backs it up. In a systemic failure, reputation becomes a hard asset. When the rule of law fractures, contracts are unenforceable. You cannot sue someone when the courts are closed. The only thing that ensures a deal is honored is moral capital. Mark Carney, the former governor of the Bank of England, saw this coming. In a post-COVID analysis, he stated explicitly, "Companies will be judged by what they did during the war, how they treated their employees, suppliers, and customers, by who shared and who hoarded." This isn't poetic fluff. This is finance. In a high-trust society, you can do business with strangers. In a low-trust collapse scenario, you can only trade within your trust radius. During the 1929 crash, speculative overreach destroyed the market. During 2008, it was systemic leverage. But in every recovery, the institutions that survived were the ones that didn't liquidate their client relationships for short-term survival. They thought they were different. The banks in 2008 thought they could package toxic waste and sell it to pension funds without consequence. They were wrong. The ones who hoarded liquidity and screwed their partners found themselves isolated when the credit freeze hit. In the coming cycle, your credit score won't be a number from Equifax. It will be the answer to the question, did you hoard or did you help when the supply chain broke? Now, let's bring this to right now, January 2026. The headlines are screaming the quiet part out loud. We are seeing headlines like, "The Coming Food Riots in America," published on January 28, 2026. We are seeing silver becoming a systemic risk as of January 27th. But look at the asset behavior. It is schizophrenic. Mark Cuban is on record saying he would choose Bitcoin over gold in a crisis. But the markets aren't sure. Bitcoin is behaving like a risk-on asset. It pumps when liquidity is high and dumps when fear spikes. It hasn't decoupled yet. Meanwhile, the dollar has hit 2021 lows as of late January 2026, triggering urgent risk-on orders from HSBC. Do you see the pattern? Volatility is compressing. The system is trying to decide what is real. We have AI agents entering the game. Airtable just launched Super Agent on January 27th. We have algorithmic trading speed that makes 1987 look like a joke. But algorithms cannot eat. Algorithms cannot navigate a checkpoint. The scarcity gap is opening up again. In India, analysts are suggesting a 70-30 portfolio split to hedge against a changing world. Why? Because they know the global trade order, the one that allowed you to buy cheap goods from 5,000 miles away, is fracturing. They thought they were different. The investors ignoring the food riot warnings. The tech bros thinking Bitcoin saves them from a supply chain collapse. The history of 2008, 1929, and Venezuela shows us that when the music stops, the only thing that trades is what you can hold, what you can move, and who you can trust. William Faulkner once said, "Don't bother just to be better than others. Try to be better than yourself." In the context of economic collapse, this is the ultimate alpha. The market will panic. The neighbors will panic. The government will lie about the numbers, revising 5.7% down to 4.4% until the currency is dust. You cannot control that. What you can control is your position in the scarcity gap. Do you own assets that depend on a functioning SWIFT system? Or do you own assets that trade when the lights go out? History proves that the collapse transfers wealth from the passive to the prepared. Don't be the person holding the bag of worthless currency, waiting for the government to fix the scarcity index. By the time they admit it's broken, the trade is already over. Class dismissed.